Hey everyone, welcome back to the channel. I'm Divya Grover, here to help you take informed mutual fund investment decisions. When it comes to mutual funds in India, one name that almost every investor has heard of is SBI Mutual Fund. And there is a good reason for that. SBI Mutual Fund is not only the largest mutual fund house in India, but also one of the oldest. Over the years, it has built strong investor trust through consistent long-term performance. The fund house was established in 1987 by the State Bank of India, which is India's largest bank. And interestingly, it became the first non-UTI mutual fund in the country. Later, France-based Amundi, which is Europe's largest asset manager, acquired a strategic stake in the company, bringing global investment expertise into the business. Now, one of the key reasons behind SBI Mutual Fund's reputation is its disciplined and research-driven investment philosophy. The fund house focuses on long-term wealth creation, diversification, and prudent risk management across equity, debt, and hybrid schemes. As of March 2026, SBI Mutual Fund manages assets worth about Rs 12 trillion. And what sets it apart is a combination of strong brand trust, a massive distribution network through SBI branches, a wide range of products, and a solid performance track record. So in this video, we will look at 3 schemes from SBI Mutual Fund that are currently on our watch list. These schemes have been shortlisted based on a combined quantitative score that includes 6-month, 1-year, 3-year, and 5-year rolling returns, along with risk-reward measures like standard deviation, Sharpe ratio, Sortino ratio, and up-down capture ratio. Let's start with the first one, SBI Contra Fund. Launched in July 1999, SBI Contra Fund looks for opportunities in beaten-down stocks and sectors that are temporarily out of favor or overlooked by investors. The fund typically maintains a well-diversified portfolio made up of fundamentally strong stocks available at discounted valuations across different market caps and sectors. Historically, the fund often struggled to maintain a strong lead over its benchmark and category peers. But things changed significantly from 2020 onwards, when the fund displayed a noticeable turnaround in growth. One interesting thing about this fund is its very high portfolio turnover ratio of around 200%, which allows it to quickly capitalize on available market opportunities. And the numbers have been impressive. Over the last 5 years, SBI Contra Fund delivered a CAGR of 28% on a rolling return basis, compared to 18.9% generated by the Nifty 500 TRI index. At the same time, the fund has also managed volatility quite effectively, which is reflected in its strong Sharpe and Sortino ratios. As of March 2026, the fund allocated 49.8% to large caps, 20.2% to mid caps, and 10.8% to small caps. It also invested 2.8% in overseas equities, while the remaining allocation was in debt instruments and cash. Its top holdings include HDFC Bank, Reliance Industries, Biocon, Tata Steel, and ICICI Bank. Among international holdings, the fund had exposure to Cognizant Technology Solutions and EPAM Systems. Sector-wise, the largest allocations were towards banks, healthcare, and crude oil. Now, because the fund has meaningful exposure to mid-cap and small-cap stocks, it has the potential to generate strong returns during favorable market conditions, especially in rallies led by mid and small caps. But naturally, that also increases volatility and downside risk. At the same time, its active management style and significant exposure to large caps help maintain diversification and offer liquidity during volatile periods. Moving to the second scheme, we have SBI Focused Fund. This fund was launched in October 2004 and aims to invest in a concentrated portfolio of 30 high-quality, fundamentally sound stocks. The strategy here focuses strongly on margin of safety while still maintaining diversification across stocks and sectors to reduce concentration risk. The fund invests predominantly in large caps for stability, while also keeping some exposure to international equities for geographical diversification. Over the years, SBI Focused Fund has regularly featured among the top quartile performers in its category. It has also displayed the ability to perform reasonably well during both bullish and bearish market phases. In the last 5 years, the fund generated a CAGR of 19.1% on a rolling return basis, which nearly matched both the benchmark and the category average. What's particularly noteworthy is that it achieved this with much lower volatility compared to both the benchmark and many of its peers. And as a result, it has delivered strong risk-adjusted returns. As of March 2026, the fund had invested 57.8% in large caps, 14.7% in mid caps, and 4.4% in small caps. It also maintained 12.5% exposure to overseas equities. Its top holdings include SBI, Bharti Airtel, Muthoot Finance, Bajaj Finance, and HDFC Bank. Among global holdings, the fund had a substantial 9.6% exposure to Alphabet Inc., along with investments in APAM systems. Its top sectors were banks, finance, and power. SBI Focused Fund follows an aggressive and concentrated mandate, and therefore it can experience relatively high volatility, especially during uncertain market conditions. However, despite that, the fund has rewarded investors well by focusing on diversification, strong fundamentals, and a medium to long-term investment approach. Now let's look at the third scheme, SBI Multi-Asset Allocation Fund. Launched in December 2005, this is a hybrid fund that invests across multiple asset classes, including equity, debt, gold and silver ETFs, and units of REITs and InvITs. Interestingly, the fund was originally launched as a debt-oriented scheme but was recategorized as a multi-asset allocation fund in 2018. Because of that, its older performance data is not directly comparable. However, under its current mandate, the fund has delivered solid performance and managed to outperform several peers. Over the last 5 years, SBI Multi-Asset Allocation Fund generated a CAGR of 15.9% on a rolling return basis, compared to 14.1% generated by the CRISIL Hybrid 35+65 Aggressive Index. The fund has also maintained lower volatility than both the benchmark and most category peers while delivering reasonable risk-adjusted returns. Now, unlike pure equity funds, this fund generally maintains a more diversified, non-equity heavy allocation. As of March 2026, the portfolio had 14.7% in large caps, 12.5% in mid caps, 12% in small caps, and 35% in debt instruments. It also had around 15% allocation towards gold and silver ETFs, along with REITs and InvITs. Its top holdings include ONGC, GAIL India, and Bandhan Bank. Sector-wise, the highest allocations were towards finance, banks, and power. With substantial allocation to non-equity assets, SBI Multi-Asset Allocation Fund may underperform pure equity-oriented funds during sharp equity market rallies. But on the flip side, it has the potential to limit downside risk during bearish phases and can deliver reasonable long-term performance. So to wrap it up, the schemes offered by SBI Mutual Fund have demonstrated reasonable long-term growth while outperforming both benchmarks and category averages in many cases. Importantly, they have achieved this while maintaining a relatively balanced level of risk. A lot of this comes from the fund house's experienced research team, disciplined investment process, diversification across equity businesses, and focus on limiting volatility through different market cycles. But as always, there is one important thing investors should remember. Past performance is never a guarantee of future returns. Like all mutual funds, SBI mutual fund schemes are also exposed to market volatility and periods of short-term underperformance. That's why it is generally a prudent strategy to diversify investments across multiple AMCs instead of concentrating everything into a single fund house, even if it has a strong track record. And finally, before adding any scheme to your portfolio, always make sure it matches your own risk profile and investment objectives. Because ultimately, the right mutual fund is not just about performance, it's about suitability for your financial journey. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Registration granted by SEBI, enlistment as RA and IA with exchange, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.